If you look at the structure of the bonds in Tanzania, they are bonds that have been issued for the government to collect the money to finance the infrastructure project, and they are bonds that have been issued by the government to collect the money to pay what we call maturing obligations, to pay those bonds which are maturing. That's why you reduce the risk of the government to default. In the US, what happens is US is rated as AAA. So if you're rated as AAA,
Yeah.
that means your risk of default is pretty much almost zero.
Okay.
Why? Because government bonds in the US are issued in dollars, yeah?
Okay.
So if it matures and then the government does not have the money to pay you, what does the Federal Reserve usually do in the US? They print money. So they will print the money and pay you out.
Okay.
So that's why the risk is low. So that's the way, those are the two risks which are exposed to bond investors. And usually for you to mitigate those risks, if it's government, the risk is lower because the government will always issue another bond, then they'll pay me. So that's why people get comfortable. But we need to do in this country, which we are yet to do, and this is the service that we launched last year in partnership with another company, is to start rating these bonds. Okay. So the bond is rated. That's why if you go to US today or in more developed markets, they are rated bonds. They are junky bonds, which these can go haywire anytime, but the return must be higher. So the unrated bonds, the inflation-rated bonds. So there are all these types of bonds which are structured because there are companies that can analyze those bonds and advise people, don't invest in this bond unless they give you X return.